The definition of total disability found in a disability income policy can vary. Total disability may be defined as the inability to perform any job, or it may be defined as the inability to perform your job. A disability income policy may cover partial disability. A partial disability does not meet the criteria of a total disability. Partial disability is typically defined as the inability to perform one or more of the important duties of the policyholder's occupation. When a disability insurance policy provides partial disability coverage, the benefit is usually a set percentage of the total disability benefit, and there is often a limited benefit period. A disability income policy may cover residual disability. Typically, a person must qualify for total disability benefits before they can collect residual benefits. A residual benefit may be paid when a person was totally disabled and then recovered, but is still unable to work full-time. The residual benefit will be the difference between what they made before the disability and what they make now while working part-time. When a person meets their policy's definition of totally disabled, the waiting period begins. Once they satisfy the waiting period, the person becomes eligible for benefits. A recurrent disability recurs within 90 days of when a person returns to work. A recurrent disability does not have a waiting period. The owner of a health insurance policy has the right to pay the premium and select a beneficiary in the case of an AD&D policy. All medical expense policies are required to cover newborns from the moment of birth. If the policy requires an additional premium payment for the newborn, it must be made within 31 days of birth for coverage to apply. Children may continue to be covered on a parent's health insurance policy up until their 26th birthday. If a child is handicapped, coverage may continue past this age so long as proof of continued dependency is provided within 31 days of the covered child turning 26. In a divorce, covered dependents have 31 days to convert to an individual policy. In the event of an employee's death, covered dependents have 31 days to convert to an individual policy. Accidental death and dismemberment policies will allow the owner to designate primary and contingent beneficiaries. If there is no beneficiary listed when the insured dies from an accident, the death benefit will be paid to the insured's estate. Mode of payment refers to how frequently the premium is paid. Most health insurance policies cannot be paid with a single premium. The more frequent the mode of payment, the higher the premium will be due to service costs. Paying an annual premium is the least expensive mode of payment. The grace period on a health insurance policy is tied to the mode of payment. The coordination of benefits provision in a medical expense policy states that if you have two group policies, one is primary and one is excess, helping to enforce the principle of indemnity. Non-occupational coverage is off-the-job coverage only. When a person has workers' compensation coverage, their health insurance policy only provides non-occupational coverage. When a person does not have workers' compensation coverage, their health insurance coverage is occupational, covering them both on and off the job. Premiums paid for an AD&D policy are not tax deductible. AD&D benefits, including those paid to a beneficiary, are not taxable. Individual disability income premiums are not tax deductible. An individual disability income policy insures a person's net income, thus the proceeds paid are not taxable. The premium paid by the employer for a group disability income policy is tax deductible to the employer. Group disability income insures a worker's gross income. The benefit amount attributable to the employer-paid premium is taxable as ordinary income to the employee. The benefit is also subject to FICA withholding. The premiums paid for both business disability buy-sell insurance and key person disability insurance are not tax deductible to the business. The proceeds paid, however, are not taxable. The premiums paid for a business overhead expense policy is tax deductible to the employer, and the proceeds paid are taxable. Premiums paid for individual medical expense policies, including LTC, are not tax deductible unless a person itemizes on Schedule A. Medical expenses, including premiums paid that are over 7.5% of the person's AGI, may be written off. Proceeds paid by medical expense policies are not taxable. When a person is self-employed, premiums paid for medical expense, dental, and long-term care insurance are tax deductible. When a person has a high deductible health plan, HDHP, they may fund a health savings account, or HSA. An HSA is funded with pre-tax dollars, the growth is tax deferred, and the spending is tax-free when used for qualified medical expenses. A health reimbursement arrangement, HRA, is owned and funded by the employer. HRA contributions are tax deductible to the employer, and benefits paid are tax-free to the employee. A flexible spending account, FSA, may be funded by both the employer and the employee. The money put into an FSA is in pre-tax dollars. Reimbursements from an FSA that are used to pay qualified medical expenses are not taxable. Managed care plans have provider networks that service plan members over a certain geographic area. Providers in a managed care network agree to offer their services at reduced rates. Members in a managed care network have insurance coverage in the network only. Managed care plans will often require a second opinion. This mandatory second opinion requirement results in fewer claims. Managed care plans often stress preventive services, such as covering annual exams, routine screenings, and certain vaccines at no cost to the members. Stressing preventive care reduces costs for the insurer. Outpatient benefits are those that a person does not have to stay in a hospital for. Outpatient care received without being admitted to a hospital is also referred to as ambulatory patient services, an essential health benefit under the ACA. The costs for outpatient care are typically considerably less than inpatient care. Utilization management is a cost containment strategy used by most health plans. There are three basic categories of utilization management: prospective review, concurrent review, and retrospective review. Prospective review is often called pre-authorization. Prospective review is used to determine whether services or scheduled procedures are medically necessary before admission. Concurrent review evaluates medical necessity decisions during hospitalization. Retrospective review examines coverage after treatment. Within a managed healthcare plan, the gatekeeper is the primary care physician, PCP. A referral from the primary care physician is required to see a specialist. Gatekeepers help managed care plans to control costs. When a business has one or more employees, it must provide workers' compensation coverage. This is occupation coverage with specific limits that are required by law. Workers' compensation provides coverage for on-the-job sickness, disability, and death. Subrogation occurs when an insurance company pays an insured's claim and then sues the negligent third party to recover the damages paid.